October 18, 2018, 12:23 p.m. Eastern Time. Order reprints. Print article Thursday. Thud. For much of the summer, worries about a trade war with China and slowing global growth were just that, problems for overseas markets, not the U.S. But stocks were slumping on Thursday, following weakness in Asia that even earnings could not erase. In today's intraday update, we see what's ailing markets, bring it back to what else, trade, and the Fed, and see what's hurting Gap, ticker, GPS, stock. My Little China Gaffe Chinese stocks took a beating overnight, and combined with last week's painful sell-offs, ongoing trade tensions, and the ages of the bull market and current global expansion, were enough to push U.S. shares lower, as well. Stocks were falling across the board on Thursday, with the Dow Jones Industrial Average and the S. Yikes. Let's start with a little bull reassurance. We do not view the recent equity market correction as the beginning of an equity bear market, is the unequivocal opening to BNP Paribas' latest missive. The current buoyant U.S. economic backdrop should continue to support U.S. earnings and will more than compensate for the rise in U.S. 10-year yields, at least for the short term, so while there may be more near-term volatility and corrections, those are buying opportunity, according to the firm. Fair enough, but with midterms looming, it seems like further volatility, and thus the potential for more down days, remains. What could be on the horizon to spark more pain? Of course, it comes back to trade. Recent global productivity growth has been underpinned by a resurgence of tech, global trade, and strong corporate titans, and a maturing business cycle means that these forces should be fostered to prolong the gains, argues Morgan Stanley, S. Chadnaya. However, the recent shift to protectionism threatens all three pillars of growth. Indeed, we are concerned that the combination of higher tariffs, the effects of U.S. tax cuts fading, and tighter monetary policy could create significant headwinds for the global economy, particularly in the second half of 2019. This reminder that the global economic expansion is mortal comes at an inconvenient time, given the outlook at home, while U.S. companies have been largely able to shrug off tariff concerns thus far. Commentary about the impacts may overshadow third-quarter earnings. After all, big multinational firms do business in many places other than the U.S., so its humming economy can only do so much. It's also poor timing in terms of what's going on at the Federal Reserve. The central bank's hawkish tone in Wednesday's minutes reinforces its track of steady interest rate increases, even as global growth decelerates and U.S.-China trade tensions haven't gone anywhere, writes FTSE Russell's Alec Young. In addition, percolating U.S. inflation readings offer little hope of a Fed pause. And all this is happening against a backdrop of rising long-term interest rates. This cocktail of increasing macroeconomic uncertainty is weighing on stocks as it doesn't bode well for corporate profits in 2019. Nothing is worse than a hangover from cocktails that didn't even taste good in the first place. Midday movers Blackstone, BX, is down 1.4% to $35.59 after reporting third-quarter earnings. The money manager said it earned 76 cents a share on revenue of $1.83 billion. Analysts were looking for earnings of 75 cents on $1.79 billion. Caesars Entertainment, CZR, is up 1.6% to $10.37 on news it could reject the $13 per share cash and stock offer from Fertitta, according to the New York Post. Gap GPS is down 6% to $25.51 after JP Morgan downgraded it to underweight. NVR is down 5.5% to $2,126.43 after reporting third-quarter earnings. The home builder earned $48.28 a share on revenue of $1.81 billion. Analysts were looking for earnings of $50.94 a share on revenue of $1.84 billion. U.S. Silica (SLCA) is down 5.3% to $16.75 after Bank of America Merrill Lynch initiated coverage with an underperform rating. Thursday. Thud. An error has occurred. Please try again later. Thank you. This article has been sent to